Hey everybody, welcome to the morning market briefing Friday, March 11th, 2022. Hope you're doing well out there. Hope you're ready for the weekend, last call of the week. We will jump right in as we're sitting here looking green on futures, which is a nice recovery from yesterday. Obviously had a strong day on Wednesday in equity markets. Rough day yesterday. Dow futures right now, though, up about 80 basis points. Now S&P futures up about 90, NASDAQ futures up about 1%, a little bit more than that, I guess. Lots to chat about the update in Russia. We've got a couple stories kind of in play, one of which is the Iran nuclear deal. Talks have been kind of put on pause. Russia is concerned that they want to make sure that these sanctions do not impact other negotiations. So they want to guarantee from the U.S. that sanctions over Ukraine will not affect any partnerships with Iran, et cetera. But Ben, give us a little bit of an update on Russia's strategy as it relates to the actual battlefield right now.
Yeah, the strategy has definitely changed. Just really quickly on markets, it's kind of crazy because with all the volatility that we've had, I think that the common theme is that we must just be getting pummeled in the markets. But right now, if you look at futures, we closed last week at 43.10 on the S&P 500 futures. As we talk right now, we're at 42.98. So we're down about 0.2% for the week. So I think that's just, obviously we've had tremendous volatility within that, but after the big decline on Monday, followed by another decline on Tuesday, we had that big rally on Wednesday, small decline yesterday, and then we're up this morning. So I think that's just interesting perspective to have. In terms of Russia's offensive, they have changed their tactics and really strategy significantly. They fired, allegedly, according to the Daily Mail, which you can debate that the quality of that source, but apparently they've gotten rid of 8 generals and replaced them as Putin is extremely frustrated with the intelligence that he's been getting and also the execution. So what's happened was they thought that they could go in, topple these cities and be done in a matter of 2 or 3 days. But obviously that wasn't the case. So instead, what they're starting to try to do is shifting their strategy to, rather than just as a full-on onslaught and then have the logistics coming behind it, the logistics previously, Ukraine was coming from behind and knocking out all the logistics, which means you cut off the Russian food supplies, gas supplies, et cetera, and really weaken morale. But now what they're trying to do is move slower and more intentionally surround cities and bomb them almost into submission, similar to what they did in Syria. So that's a new strategy that Russia is pursuing, which is a longer strategy and an uglier strategy in terms of the cost of life and the humanitarian issues that it has. So that's what we're seeing is, for example, in Kiev, we're seeing, instead of that military convoy just parked right outside Kiev, what they've done is they've kind of moved into the forests and towns surrounding Kiev and letting the airstrikes do the work there. And they're also targeting some of the infrastructure in order to really get at the heart of what drives the Ukrainian economy, the electricity, everything like that. So that's what they're trying to do. On a sanction perspective, they are considering seizing assets of U.S. companies. A lot of U.S. companies have just walked away from their assets anyway, so I'm not sure. I don't think that'll be a massive impact for them, but that is something to watch. Vladimir Putin, for his part, said this morning that, quote, there are certain positive shifts in talks with Ukraine. Potentially that's an allusion to this talk that Ukraine might be saying, hey, we're willing to be neutral. We're willing to not join NATO for the foreseeable future. That is a prerequisite to meeting with Zelensky, but I still think that the meeting with Zelensky is a ways off. Zelensky continues to say he's not going to surrender, and that's a condition on which they would actually come to some sort of an agreement. I contend that Putin is not going to meet Zelensky. Putin needs to meet Zelensky in order for this war to be over, and he's not going to meet Zelensky unless Zelensky's bearing the white flag. He might not have a term that I'm going to surrender to Putin, but that in effect will be what it'll be. The U.S. response is that Biden is going to call for an end today to Russia's preferred trade status or most favored nation status. So it essentially allows the U.S. to use whatever tariffs that it wants. I'm surprised that it lasted this long, but he does need Congress's blessing on that, which I think he'll get. Putin, for his part, says that sanctions have only made us stronger in the past, which I think is categorically false. But I don't think Putin really cares about fact checkers anymore.
Yeah, I'm not surprised by Putin's response to that. I don't agree with it, but I'm not surprised by it. The most favored nations thing is interesting because even prior to this conflict, even before people were even talking about this, it's pretty wild that Russia was on this list of most favored nations to begin with. I would not really be able to hearken back to a recent period in which we would view Russia as a real ally and a necessary trading partner. So kind of interesting on that front. We are seeing, Ben, there is an impact on all this, kind of on the political side. I think we've done a decent job of trying to stay relatively apolitical on this as we're analyzing it, but we are getting some data, and there's no editorial read through here. From us, this is data from the Wall Street Journal, but the Wall Street Journal is showing a 57% disapproval rate of Biden, essentially the same as where he was in November. But we are seeing some moves on specific favorable and unfavorable responses. Ben, how's that shaking out in terms of when you think about the president, for better or worse, whether it's right or wrong, people tend to think of kind of the major issues and how they view those. It's kind of like the quarterback of a football team. They get a lot of credit when they win. They get a lot of blame when they lose. It's not necessarily all their fault, but that's how people view them. What are we seeing kind of on the finer print?
Yeah, we had one client last week who guessed that I had a political leaning that is the exact opposite of my actual political leaning. So I actually take that as a credit. So I'm going to try to maintain that right now. But essentially what we're seeing is it is the economy stupid. And that is that we're seeing significant shifts within the electorate base. If you look at, this is a Wall Street Journal article, they're saying that Hispanics, which was a dead heat in November between Republicans and Democrats, Republicans now lead Hispanics by 9 points over Democrats. In terms of African Americans, Democrats had that by 44 points. I had to double check that. Democrats had 56%, Republicans had 12% in the same poll from November. Today, Democrats lead that just by 8 points. So down from 44 points to 8 points. So we're seeing some significant movements because it's the practical realities of, hey, I care about inflation, I care about employment, I care about this Ukraine thing, and all these other things either are not as important issues anymore, or they're dissatisfied with how they're going. So for example, things that were favorable that were deemed as credits to President Biden was the response to the Russian invasion and the State of the Union. Things that were unfavorable was the COVID-19 response, which where the Democrat lead fell. Education, progress on education, the Democrat lead fell. Protecting middle-class families, Democrats had a 5-point lead on that in November. Now it's dead even. And inflation, there's a 63% disapproval because of that. And it is the most important issue right now. The second most important issue is Ukraine. So when you're seeing these more immediate pressing concerns take place, you see these sea changes in electorate and constituencies. And I think this is very interesting. Great book recommendation I have is The Fourth Turning by Neil Howe. He's actually updating it right now, but it talks about the shifting demographics and how that demonstrates itself over a period of years. I'm not just talking about this point, but over a period of years, how the generational shift really can influence major policy changes. And he hypothesizes we're in the fourth out of four turnings right now, which could set the stage for a refresh of how politics is governed, how economy is governed, how the world is governed over the next 80 years.
Thanks, man. Got a couple of earnings reports to get to, but before we do that, I want to throw to Tom. Tom, wild week, choppiness, obviously in equity markets, and has been kind of alluded to. We're essentially flat for the week, at least as we're looking at futures pricing right now. Where are we kind of wrapping up the week on the fixed income front?
I wish I could have as rosy a report as Ben. With all the volatility, unfortunately for the bond market this week, it's all been downside. Really just an unusual week. I think that all of it is just anxiety ahead of potential rates. We saw a very strong sell-off yesterday, but it was really centered around the 7 and 10 year. We had a 30-year bond auction that was excellent. So I guess the read through there would be that people think that this inflation is going to be relatively short term, in the sense that it's going to last for a couple of years, maybe, but the 30 year is really unaffected. There's a ton of demand, foreign demand for the 30 year. I think a lot of it has to do with the fact that the ECB move yesterday is probably going to be one that causes a lot of problems with foreign debt. And so ours obviously is a lot more stable and a lot more, reliable in terms of credit quality, in terms of stability. And so people are funneling their money there. So there's tons and tons of demand for the 30-year treasury and almost no demand for anything else. So the 7-year and the 10-year are both at 2%. There are parts of the curve where the sort of 3.5 and the 4-year bonds are more yieldy than 5-year bonds. We're just exceptionally flat on the front end of the curve. And then there's really not even that much give up in terms of yield going from, 10 years to 30 years. So it's just a really odd shape, a shape I've not seen before in terms of what the yield curve is doing. What it allows us to do, though, is we can really buy bonds that are at good prices as we have bonds come due and income come due. We can basically sprinkle money anywhere between 10 and 20 years and get really good value compared to where we've been over the last couple of years. The two scenarios that could happen, though, are potentially they raise rates and the front end of the curve falls, which would be net beneficial because we've got a lot of bonds on the short end of the curve for the reason of avoiding interest rate risk. And we've seen sort of a counterintuitive move, the short end being beaten up more. Or we see rates continue to rise, in which case we bought excellent bonds at excellent value that are still short, that are not going to be continuing to be beat up by moving the yield curve. So it's really just been a tough week, but I think we're well positioned. Our performance has been very good, despite the fact that the performance overall of bonds has not been very good. Next Wednesday is going to be a big day. Whether we get one hike or two, my expectation still is one. I think we're going to see some more volatility. It could be the upside, though. That's sort of my probabilistic leaning, is that I think we're going to see a better week for bonds next week after we see a rate hike. But again, it's very difficult. There's so many inputs. We've got foreign buyers, we've got domestic buyers, we've got a lot of moving parts with the war. So it's very difficult to suss out exactly how the yield curve is going to move, but that would be my expectation.
Thanks, Tom. Good stuff. Here's to a better week next week. Ben, we got earnings from Oracle, also DocuSign. Oracle, overall, I'd say like a solid C quarter. It was good, not great. It was relatively in line with expectation, but not necessarily strong. DocuSign forecasting slower growth. Stock's taking a real beating right now. What would you take away thematically? We've been talking so much about Russia and Ukraine. What would you say thematically is the real impact when we're looking at earnings reports like these kind of one-off reports as it relates to how we're trying to think about portfolios?
Yeah, it's a great question. I think that we just need to continue to emphasize quality. And I think that you have some companies that, if you're looking at Oracle, Oracle kind of jumped over a really low bar. Their stock had been down 25% in the last 3 months. So they jumped over a low bar. Their quarter wasn't even that great, but they were able to put up some numbers. And I think the market appreciates that. If you had this earnings report probably 6 months ago, the stock might have been down 10%. But based on where the stock is now, it's more reasonable. DocuSign kind of fits in that Netflix category of a work from home thing. They're decelerating from up 45% last year to up 17% this year. And you just don't want to play in that chaos. That's not where you want to be right now. I think where you want to be is companies that are a little bit more insulated from the chaos. What we do is we have a category, and whenever we pitch a company, called business robustness. we evaluate the business relative to the economic cycle and how well it withstands those cycles. And I think those businesses right now are the ones that you want to be targeting. So I think that is the area where you want to be targeting. And for example, and you can take some risk in that. For example, American Express, I think is a decent opportunity. And I think that you want businesses that are well managed and that are robust to that cycle. And I think that Oracle is kind of that way, and it's only down 2% today. So I think that this bodes rather well for the earnings season coming up in April. GE, General Electric, just reiterated guidance yesterday for their year. So I take that as a huge sign of confidence, because GE, with all of its supply chain issues and business all around the world, the fact that they're not seeing significant degradation in their business gives me confidence that the overall economy is actually still moving forward fairly well. And we're actually seeing that in some of the larger economic data as well.
Excellent. Thanks, Ben. Thanks, Tom. We're going to wrap it up there. Hope you guys have a great weekend. We will be back Monday morning at 8:30, and we'll talk to you guys then.